The biggest friction point in trading is I have talked to guys who have read books from Warren Buffett, Peter Lynch. They have seen a few podcasts. They create some sort of decisions that yes, this is what Warren Buffett did to win in the market. They might have read about Jim Simons and they be like, yes, we will be the next Renaissance technology. But it's not that easy. Without Jim Simons, he took a quantitative approach, whereas talking about Warren Buffett, if you're going through the fundamental approach, you guys have absolutely no way to backtest it properly. Even if you're manually backtesting on candlestick data, you have a lot of human biases involved, emotional biases involved, right? Now, let's come back to where a discretionary trader leans on intuition. A quant writes down a model. So what is included in the mathematical side of quantitative finance is calculus, probability, and stochastic processes to describe how price. Statistics is used to estimate risk, testing signals, separating skill from luck. Just a second. Please refrain from raising the hands till the PPT is going on. It's distracting. Now, computer science. How do we build our mathematical models? How do we actually execute those trades? How do we actually backtest? We build it through data pipelines. We fetch data from data vendors. The data could be as low as tick data. Tick is basically what? Let's say there is me as a buyer and there is somebody else as a seller. Every time I punch in a trade, right, I put in an order to trade. That's a tick. Right? It could be cancelled, it could be filled, it could be anything. But again, it's a tick, right? And you can go as low as there are three levels to data: L1, L2, and L3 data. L1 being your candlesticks and everything, and L3 being as minute as tick data. Now, data pipelines. There is an entire process to do the modeling. So first, we build our data processing and handling pipelines. This is where we fetch our desired data. It could be higher time frame data, 1 day, 1 hour, whatever. Now, common data vendors, I will tell you, are Alpha Vantage, Yahoo Finance. Yahoo Finance is absolutely free. Although, if you are starting in quantitative journey, it's good enough. But other than that, honestly speaking, Yahoo Finance is not exactly a good reliable source of data. You have Data Bento, you have Alpha Vantage, you have, if you're going for cryptos, you have your Binance API key is absolutely free. Now, where does the finance part comes in? Without a good knowledge about economic rationale to build a strategy, it could be like something like, I've seen people over clustering on X sector, right? So let's say when you are doing a backtest over the last 10 years, you can obviously see that tech startups have performed actually better in the US stock markets. But when you are backtesting a model, if your strategy is purely based on that, yes, we will take maximum number of stock from the tech sector, of course, it's overfitted, right? It's overfitted to tech performing well in the history. But that is not a guarantee that it will perform good in the future as well, right? Now, markets are now run by models. Honestly telling you, just like there is an AI revolution in the world, I see, just a second, there are a lot of people waiting as well. So, I've seen this quantitative shift, especially let's say US stock market. In US stock market, 80% of the entire volume is driven by algorithms. The banks, the funds, the firms, everybody you are seeing right now is using you as a data point right now. These days, even if you are a retail trader, if you don't have a lot of capital, in reality, when you open a broker account, you're not even trading on real market because you have such less capital that they just don't care about it. They are giving you a simulated account in reality. Your trades are never even being punched in, but instead is being sold to quant firms. so they can take a guess on what uneducated retail traders are taking a trade, and that's how they are building statistical arbitrages as well. Right now, talking about the latency, quantitative finance. First thing that I would like to get out of your mind is that quantitative finance is not just trading in milliseconds, nanoseconds. The quantitative firms do trade in nanoseconds and milliseconds, but being a retail quant, you don't have to focus on that. If you have a good enough corpus, now what do I mean by corpus is a capital. You don't need to go down to lower time frames. You can easily make money on higher time frames, create a model. There are again people joining in. You can easily make money on higher time frames. 1 day time frame model that can easily beat your buy and hold. Let's say with your buy and hold, you are making a compounded annual growth of 12%. With a quantitative model with a smart algorithmic predictions, you could easily make up to 20-25%. That's already double what you would have made in your basic buy and hold or FD returns or mutual funds returns, right? Now, what was the first thing that started this entire quantitative journey was almost, if I could pin it down to, that was the Black Scholes coming out. That was the Black Letterman model coming out from Goldman Sachs. Over the last few decades, trading has shifted from trading pits in the NYSE or NSE, and has gone to the servers, purely servers. Now people are not even in the pits, right? Now let's talk about from prices to returns. Quants rarely model prices directly. You know why? I will tell you, because let's consider this as a fact. The price that you are seeing right now in S&P 500, let's say your 1 hour candle moved $10 on S&P 500 in 2026, and that same $10 move could have came in 2016 as well. So 10 years before, the 1 hour candle moved $10, and in 2026 the candle moved on $10. Does that mean the same thing? Of course not. There were huge inflation changes. There was huge purchasing power parity differences. GDP growth was different. A lot of things changed. Then why are we treating, let's say, your basic EMAs, SMAs, why are they treating that candle in 2016, maybe with lower volume, the same as a candle that's moving in 2026? And that's why we don't model prices directly. We model the returns. We work on percentages, logarithmic. Now, because the percentage change from one period to other is practically the same, right? It's not dependent completely on the price. Now, returns compare across assets. Is the if you are comparing the price, you have to normalize it on a scale of 100 across assets to make it even out. But if you are considering the returns, you can easily compare it through asset to asset. This is your simple return, and this is your logarithmic return. Now let's talk about return versus risk. So in today's world, every investment, every money-making avenue also has their own risk attached. Even if you are doing some FDs or maybe putting your money in government bonds, that's also not completely risk-free, but still we consider it as a risk-free investment. Now, return is the reward you expect, and risk is the uncertainty around it. Now, it's usually measured as volatility or standard deviations of return. The two are inseparable. Inseparable in the main, there is no free lunch in the market. More risk, more expected return. As you can see right here, holding cash, it holds almost no risk. Because why? You are holding pure cash. Where would it go? Nowhere, right? But it will, of course, depreciate due to increasing volatility, increasing inflation, right? The bonds are considered much more risk-free, but again, they still have some sort of risk. Equities have more return probability, but they again have more risk. Now, let's talk about randomness. In reality, in this world, the prices are random walk. There is a small signal to be found which is already very efficient in developed markets. Let's say you are trying to trade in US markets. Do you know you are competing against people who have petabytes of data, and they are targeting every single minutest signal. When you are trading on a signal, when you discover a signal and you are trying to exploit that signal, of course in some time that signal will decay. That expected value of that signal will decay, and that's called our alpha decay. So the simplest faithful model is a random walk. Tomorrow's price is today's price plus a random shock, right? And this is somewhat relational to, if not directly, but if for the simple terms I will say, to Monte Carlo, right? In Monte Carlo, what we do is we will shuffle things around, add random shocks, and add that shock could be positive and negative, and at the end of, let's say, 10,000 runs, 20,000 runs, we get an expected median, right? Now, let's talk about the normal distribution. So what is a normal distribution? This image you see, for non-technical people, this is called a bell curve, right? Add up many small random shocks and they pile into the familiar bell curve. It just takes two numbers, the mean, that's your in the center, and your standard deviation, that's your width, and you can calculate where the most of your outcomes come in. So if most of your outcomes come into this area or this area, right? Now, reality checks are that markets do have fat tail events. Now, what do I mean by fat tail events? They are called black swan events as well. They are your flash crashes. You could consider the 2008 crash. You could consider the 2020 crash. Was it expected? Of course not. But that is the job, being a quant, to make sure that you are considering those factors as well. Because if I talk about the 2008 crash, it was 20 times of a normal standard deviation, but it still happened, right? Now, $1 today beats $1 tomorrow. Again, money has a time value, and cash flow can be invested to earn interest. So future cash is worth less today. Converting future amounts back is called discounting. Is basically your present value of the money. I'm sorry, just a second. A lot of people are waiting. Join in. Now, you might have heard this from a lot of hedge fund guy, a lot of famous investors. That is, don't always put your eggs in one basket. Now, how can I relate it to quantitative finance? Is if you are making a model, you always have to, let's say there are two types of model. In lump sum, in rough, let's say there are two types of model. One type of model is when you're trying to model a single assets and ensure that you can smartly exit without having huge drawdowns and make the most of the upside momentum, right? In those models, let's say you're running single assets model, and then you have your multi-asset model. Now, what do I mean by multi-asset model? It could be you are trying to create a ranking based out of entire S&P 500 universe. You could also add risk of assets, like you have your treasury bills, T-bonds, you have your commodity ETFs like your silver ETF, you could have your gold ETF included, you could have your Bitcoin ETF included as well. The only free lunch, because again, everything at the end of the day is moving around correlation. Now, what do I mean by correlation? I mean, in fact, in quantitative finance, there is something called that all correlation goes to fucking hell when you have everything crashing. In a flash crash, in a black swan event, regardless of your correlation, everything is gonna fall. But still, if I had to explain correlation can be explained in terms of beta as well. Your index funds, that just a second, again a lot of people are joining in. I don't know why they are still so late. Now, your baskets in one, right? Yes. So explaining beta, whatever index you have, we will be talking about US index, that's your S&P 500. Consider that index to have a beta of 1, beta value of 1. So if a stock has a beta value of 1, a correlation of 1 to the S&P 500, what does it mean? That if S&P 500 is moving upwards 1%, the stock is also expected to go up 1%. Let's say if in correlation to S&P 500, the stock has a beta of 2, the stock is expected to go up 2% on a 1% upwards move, and vice versa when it's going down. Now, why do we try to find orthogonal and non-correlational assets? Is because let's say if your main primary asset S&P 500 is going up, that is with a negative correlation, that specific low risk asset will not perform. But when will it perform? When your S&P 500 is taking a nosedive. That's when your negative correlation assets will start going up. It will show an inversely relational momentum, right? Now, how quants put a number on the risk? Now, one of the few metrics that we look at is, first is Sharpe ratio, second is value at risk, and third is maximum drawdowns. If you're targeting quant firms, they also give a lot of shit about Kalmar ratio. You should look into it as well. Now, risk is the abstract till you measure it, right? Return earned per unit of risk. Higher Sharpe ratio is the better. It rewards smooth gains, not lucky spikes. Now, I'll tell you the ranges. So if you have a Sharpe of above 1, that means your strategy is making some sort of money. But if you have a Sharpe ratio of 1, it's giving out decent returns, right? It's a good Sharpe ratio. Anything above 1.5, it's actually a good Sharpe ratio. Any Sharpe ratio, if you are making a model and your Sharpe ratios go above 2 or 2.5, you have an excellent model at hand. And once your Sharpe ratios start going above 3 is when you come into the risk of overfitting your strategy. Now, what do I mean by overfitting your strategy is that you are making sure that your strategy is working perfectly fine in the backtest, but that data might not exactly repeat in the future, right? In the past, X, Y, Z happened in time series, but in the future, rather than X, Y, Z, it could be X, A, B, right? So that's when your entire model will start showing massive losses, even though your backtest showed a huge profit. Now, value at risk. The loss you should not exceed on 95% of the days. Now, let's talk about maximum drawdown. If I create a trough, a sort of mountain, the maximum drawdown is considered when you're going up, your portfolio is going up, and suddenly you have some loss days. How much is it going down, right? From the peak and then again going up is considered to be your maximum drawdown. It measures the pain an investor must live through in order to continuously make money. Now, let's talk about options. If you are a non-finance guy, you should definitely read about derivatives. It is used to hedge risk or speculate with leverage. And what is a call? The call is the right to buy the option at strike gain, a bet that the prices will increase before the expiry. If, let's talk about American options or Indian options, if your let's say you bought a exercise price at $200, if the stock does not reach $200, your option will expire worthless. Now, what do I mean by put? The put is that you are betting that specific asset will go down. So if it goes down, you will start making money. Now, how do we hedge our options is through multiple methods. There are a lot of option strategies. There are butterfly, half butterfly. These are the very basics one. Then there is gamma hedging and all. Now, this is honestly, Black-Scholes is one of the very outdated option pricing models. But starting finance, you have to get your basics clear, right? Because through those basics is when you can model difficult models, right? In 1973, Black-Scholes and Merton derived a formula for options fair value. That is, at X point of time, what will be the price of the option when it is expiring? The insight is that an option is replicated by continuously trading the underlying. So its price is fixed by no arbitrage. These are mostly used in European markets, because European markets options cannot be exercised before expiry, whereas American options can be exercised at any point of time. The Greeks. These are the Greeks included in any option pricing, that is your delta, gamma, theta, vega, and rho. Again, very basic finance. Now, what do quants actually do? The job of a quant is to find alpha. Now, what do I mean by alpha? It is to find the excessive returns over the market, over buy and hold of an index fund, right? Simple. Or maybe buy and hold of that similar asset. Hunting predictive signals in data, prices, fundamentals. Now, there are other things as well. That is your factor investing. Factor investing is a systematic exposure to value, momentum, quality, size, and more. Now we have statistical arbitrages in quantitative finance. What do I mean by statistical arbitrages? Are mean reversion, pair trading. That basically, let's say, I will give you a very basic example. Let's say GBP USD and Euro USD. Both are highly correlational, right? Let's say GBP USD did move 1%, but Euro USD for some reason only moved 0.2%, but they are highly correlational. So Euro USD should have at least moved 0.9% or more than, or let's say maybe 1.1%. This creates, I'm just being very hypothetical, being very basic. This creates an arbitrage opportunity that both the prices, the GBP USD will diverge and the Euro USD will increase to finish that gap, right? Now, market making. What is market making? Quoting both sides, earning the spread between the buyer and the seller, and managing the inventory risk. Now, what do I mean by risk management? Is sizing positions and capping exposure. Once you have your model ready, right? A huge part, one of the very last parts of quantitative finance model making is your risk management. How much to risk on each single trade. Then comes your execution. For big firms, let's say, or big capital, execution matters a lot because you have a lot of capital. And with that lot of capital, let's say if you are trying to trade with billions of dollars, that billions of dollars is of course going to move the market, right? And if it's going to move the market, you have to split your orders into a lot of small packets, a lot of small orders, so that it does not move the markets at once. And that's what you retail traders might call stop loss hunting or something. Honestly, they don't care about stop loss hunting. But still, this is how execution works. Now, from idea to live trade, this is how the entire quantitative pipeline will look like. First is to get the data, get clean data, handle it properly. Then we build our hypothesis. Now, what is a hypothesis? In scientific terms, you can call a hypothesis as an idea, right? An idea that might generate you some profit. Maybe, let's say, a build-up predictor. That's a signal generating part of the pipeline. Then we backtest on history completely quantitatively and completely honestly, because if you are still trying to maximize your returns without a good signal, what is the point of it, right? Then after your backtest, this area takes a lot of time, honestly, signal and backtesting, because it might not work with your single hypothesis. You might have to create a new idea, a new economic rationale. Yes, this might work out now, this might work out now, and then you backtest it, it fails, then you retry, right? Now, once you have this engine sorted, you start with risk and sizing. And once you have your optimum risk, there are a lot of ways to decide that as well. I've posted a few videos about it on Instagram as well. Kelly criterion, half Kelly, full Kelly, 2x full Kelly, entirely up to you. Then we have our execution part. Trade live with minimal possible costing. Now, the monitoring part is watch your pipeline take rates. Make sure that it is trading as per intended. And after a certain point of time, check that data, check the new data, check your algorithm that it's working properly, maybe tweak a few parameters, right? And retrade on that. Basically, all of the strategies goes like this. You create a strategy at this particular point of time. It will go up, it will make you profit. And at a certain point of time, that signal value will start reducing. This point of time is called alpha decay. Your strategy will start losing money and you have to reiterate, maybe add a new parameter, tweak your current parameters to make sure your strategy still works. Now, the takeaways are purely here. If you guys want, I can send this to you as well. A few quant books that I would really tell you to read is Options, Futures and Other Derivatives by John Hull. Then you have your Stochastic Calculus for Finance by Shrev. But if you don't know, if you don't have the foundation for calculus, right, don't go directly for stochastic calculus. And this guy, Lopez de Prado, one of the godfathers, according to me, for quantitative finance. This one book, Advances in Financial Machine Learning, will actually tell you how difficult the quantitative finance is, really. Now, model returns, not prices, respect the randomness. Don't try to fit your model according to randomness. Return and risk are inseparable. Volatility is the price of admission. Again, the big takeaways. Now, let me start with the corporate side of the story, right? Just a second, I will present a new PPT. Yes. Now, it's all about careers in quantitative finance. It's a practical guide to breaking into quant development, quantitative research, or quantitative trading. The skills you need to get a corporate offer in it, right? Now, how does the quantitative landscape works? The quants build the models and systems that price, trade, manage risk across global market. Now, the quantitative researchers are one of the highest paid in the world, honestly. And the demand spans several kinds of firms. Each have their own play style, their own base, and their own pay. Hedge funds, you can have systematic strategies at place, like Citadel, Two Sigma, Millennium, D-Shop. You have your prop trading firms, proprietary trading firms, that trade the firm's own capital and mostly are fast and tech-led. You could also look out for Jane Street, Optiver, IMC, and Hudson River Trading. Then we have our market makers, the HFTs. The HFTs work on nanoseconds, ultra low latency, obsessed with technology, honestly. They have a jump tower virtue. Then people looking for quants are investment bankers, that is your pricing, risk, and structuring on the sell side. You have your Goldman Sachs and JPM, MS, asset managers that factor and systematic trading at scale. You have your AQR, BlackRock, and Mango. Now, fintech and crypto, you have your exchanges, DeFi, right? Now, two parts. The main two parts are the quantitative developers and quantitative researchers. Again, these are the only ones you could get into in the start. And then there's a third role as well, that's your quantitative trader. But without experience, there is no possible way to get directly into quantitative trader role. Now I'll tell you the difference between both. What does a quantitative developer does and a quantitative researcher, so that you have a clear idea on what you want to do with your future. Now, a quantitative developer builds the softwares, the systems, and ensure the performance, the low latencies, the infrastructure, the coding infrastructure of it all, production trading infrastructure, backtesting engine, and data pipelines. Mindset is completely on the engineering side of it all. Now, what does a quantitative researcher does? They find the alpha. They find the edge that the company could actually exploit. They create the models, signals, and statistics, the trading strategies and alpha, risk models, and forecasting. Mindset is completely scientific and data driven. At smaller firms, at smaller firms, and even if you are being a retail one, you actually do both. You do the quantitative developer part as well, and you do the quantitative researcher part as well. Then let's talk about the quantitative developer more, right? Now your typical quantitative developer stack looks more like C++, Python, Linux, KDB+, SQL, networking, HFT, Git, CI/CD, right? Who thrives? People with strong computer science fundamentals, system thinking, and an obsession with performance and clean, correct code. These are the engineers of the trading floor. Quant devs turn ideas into fast, reliable production systems that move real money. Now, what do they do? Build and maintain trading execution platforms, low latency, high reliability infrastructure, develop backtesting frameworks, pipelines, put research into production code, optimize for speed, correctness, and risk control. Then your quantitative researcher, they have to work with Python, NumPy, Pandas, Polars, vector BT, statistics, machine learning, time series optimization, to name a few. Who thrives? A person with scientific mindset, statistical rigor, creativity, and a healthy skepticism towards your own results. Now, what do they do? Hunt for predictive signal, alpha, and data, design, test, validate trading strategies, build statistical and ML models, fighting overfitting, backtest rigorously, estimate real trading costs, work with devs to make winning ideas work. Now, what do you actually need? Basically, if you want to be both roles, share a quantitative goal. It's just that the emphasis differs, right? If you want to be a developer, you should focus more on C++ and low. If you're a researcher, you should focus more on Python, right? If you are a developer, you should focus more on algorithms and data structure. But again, it's a bit shared between a researcher and a trader, or researcher and a developer. Now, your machine learning part, the developer has absolutely no need to focus a lot on machine learning, whereas a researcher, the machine learning, the markets, the finance, the economic rationale is very important, right? Now, the backgrounds that will get you hired into quantitative finance. Again, there is no single path to it, but I will list out the ones that could actually lead you a quant role. Now, the bachelor's, you could definitely go for computer science, mathematics, physics, statistics, and electrical engineering in general, especially for quantitative developer role. And because honestly telling you, the bachelor's is not very looked or sought after in quantitative roles. What they actually or are is a master's at the bare minimum. With a master's role, you could actually land a quantitative research job, whereas with bachelor's, maybe a BTech in computer science, electrical engineering, or similar mathematics or physics could land your quant dev roles, maybe highly unlikely, but still a research role at small firms. But a master's, now the master's could be MSc, MTech, and MSc could be in mathematics, applied mathematics, physics, statistics, and your MTech could be in computer science, statistics. There is something called MFE as well. What is MFE? It's MSc in financial engineering. I'm also doing MSc in financial engineering. So in that, the entire focus is on the quantitative researcher part of everything, right? Now, there comes your PhD. PhD is the basic norm at top funds because they look for people with great scientific rigor, right? Now, firms do actually weigh raw ability over school name, but those elite schools like your MITs, your UC Berkeley's, your Princeton, then in Munich you have your TUM, you have Technical University of Munich, you have Bocconi. These elite schools actually open a few doors but can't land you a role, especially in quantitative finance, until and unless you have that extreme rigor, right? Now, what to learn? Again, coding, programming is the bare basics. Master one language deeply. Honestly, my suggestion would be go with Python and then switch to C++. because that's an easy transition. Directly as a beginner going into C++, you're going to get confused a lot. Then we have our CS fundamentals, data structure, algorithm complexity, and the basics of how computer run. Advanced probability and statistics is very required. Distribution, inference, regression, and hypothesis testing. Then we have our linear algebra and calculus, the math under machine learning. We would also go for topologies. Then we have our markets. Markets in the sense how exchanges work, orders, instrument, and risk actually work in live trading. And practice, you can do lead code, mental math, beam teaser, Jane Street puzzles you could do. There are a lot of things you could actually try to build your own models. That's what I focus on. My personal suggestion, ironically, still people are trying to join in. Just a second, I will let the poor guy in. Done. Now, this is like just a second. Yep. The way that I looked for, I love quantitative researching. I love the trading part as well. I took the route that is not your very basic way. I did go through the research route in the way that I read, I will honestly tell you, infinite number of quantitative trading, algorithmic trading and finance research papers. And when I read a research paper, I would actually write down the parameters they used and how did they arrive at those parameters. And I will try to reverse engineer the entire paper myself. So let's say they use A, B, and C to build a trading model, a quantitative trading model. Now, they would, of course, not tell you the weights that they used or the exact maths that they use. And that's what I tried to do. I tried to reverse engineer it, go back, right? Use them in a way so that I could achieve somewhat of a similar result. Now, that's how I learned quantitative trading, honestly. Aside from all this is very basic. Now, show, don't tell. Your real project, a portfolio, definitely beats a transcript of courses that you do in your bachelor's or master's. Pick a few projects, do them extremely well and write it, right? Like I said, replicate a paper. Now, it could be backtest a strategy with honest cost and slippage, build a trading bond that could be via a crypto or paper trading API end to end. You can do quant hackathons, paper trading on Kaggle, right? Then you can replicate a paper, reproduce a result, and stress test whether it holds. Compete in top competitions like Kaggle, IMC Prosperity, Optiver, and other trading games. You could also have your own open source GitHub or data library wherein you can show it as your portfolio. Write a clean blog or a clean GitHub that shows how scientific you are and what's your approach to quantitative trading, right? Quantitative finance. Now, breaking in. Honestly, that's the most difficult part. Now, quant hiring is the most brutal employment funnel that could possibly be there. Now, the funnel is, let's say, 1,000 apply. Only 120 are actually assessed. And out of those 120, only 20 get the interview. And at the end of the day, only 2 might get the offer. Or actually, I've seen in a few cases, nobody gets the offer. And again, it's very difficult. Internships are the front door. Apply for 12 months plus internships. Specifically our internship in quant roles, even if you can get a 1 month internship, right, apply for it, give it your best. Target for firms that fit your strengths and track competition and puzzles. Build signal, your network, and your referrals. Network deliberately, because the people you have talked to, networked with, they are more likely to give you a referral. And with that referral, you could actually get into a firm a bit easily, but also again depends on your abilities. Now, the interview gauntlet, how does it work? It works through a screen, resume, and referral filtering. Then you have your online coding and mathematical. Then you have your technicals like coding for developers and brain teasers, puzzles for researchers. Then we have your on-site deep dives and mental maths. And then you get your final offer letter. This is the probably most difficult thing to do. Again, quantitative finance is not easy. But honestly, I will tell you, The corporate side of it is difficult, but if you are trying to be just a smart trader, right? Quantitative finance is not necessarily something that you need to have people. There is a lot of quant elitism everywhere. You see X, Twitter, Instagram, all social medias are covered with people with multiple degrees, and they always are preaching you some crazy possible shit. But again, if you're just simply trying to beat buy and hold, you don't need to learn stochastic calculus. You just need to read research papers, and you just need to have the contextual knowledge, the conceptual knowledge, and try to build a strategy of your own. And definitely with time you will be able. Now, coming back to the interview part, they again like for C++ for developers, Linux, statistics and ML, mental and market math, system design, or research case. Then talking in US dollars and Indian rupees as well. Now, quant is among the highest paying careers a BTech grad can target in India, but the top numbers sit at a handful of elite firms and vary widely. Entry level could easily be somewhere around 25 to 60 lakhs. That is about your, I would say, $70,000 if you are talking in Indian terms. But if you are doing your undergrad from USA, Europe, you can easily get $100,000 or more, maybe 150K. And 3 to 5 years in, you could easily achieve 1.5 CR in India. That would sum about to be 200K or 250K in USA. And a senior quant, this is the base pay. The best part about quantitative finance is that your base pay is absolutely insane and stacked. But if your algorithm is actually deployed live into the market, the best part is the bonuses. You get bonuses that are 2x, 3x, maybe even sometimes if you're a senior quant or senior portfolio manager, that are 10x your base pay, right? Now, let's see how careers actually progress. You start with a junior analyst or a developer as basics, right? Work under somebody, learn the system. Then we have a quant dev, a mid-leader role. Then we have a senior, that's your lead. It could be a team lead, right? And then the best you could go is own your own portfolio, own your own book as a principal or a portfolio manager. Now, a 12-month roadmap, you should definitely start with the Python, data structure, probability statistics, calculus, linear algebra, and then you have your 4 to 6 months. At least try to build 2 to 3 portfolio projects. Start with brain teaser and mocks. 7 to 9 apply for internship, competition, network, referral, quant hackathons. Then your journey from to the end of the year, convert to a few assessment on site and negotiate offers. Not so easy, but still, if you really want to do it, why not, right? And pick a lane. It could be a builder or an edge finder, then go deep, right? You have your resources right here. Just a second. The communities as well for Reddit. And I mean, you came from my Instagram, so definitely I have my own cohort as well. I will show it to you in a few minutes, the things that we have covered till now. You could again pick a lane of your builder, that's your developer, or a edge finder, and go deep in it. First thing is to explore both the possible ways so that you know what you like and what you are more supposed to be, like where your strength lies in, right? Pay is high and the competition is definitely higher. Now, just a second. So this is my quantitative cohort as well. I cover about I have distributed the concepts into 3 main sections. It's your easy mode. The easy mode has a lot of basics. It has code notebooks right here, like the Python, quantitative mistakes to avoid, right? Then we have our intermediate, that's our quantitative concepts. A lot of those concepts are also covered in YouTube in a graphical visual way. And as you can see right here, in each of these you have your notes attached to it, code notes. These are your models and your explanation notes. Then we have our final boss. That's your machine learning, neural network, and econophysics. Now, let's start with our Q&A. Just a second. I will be opening the chat box to everybody, and you guys can put in your messages. Yes, please go ahead and drop in your text so that I can help you through them. If you don't know the chat box, it's on your bottom right side. You know, Rust in all this is mostly used for your quantitative developer side to build a proper infrastructure, get the latency right, on work on low latencies. Some people do prefer C++ over Rust, but again, it's something that would come into the culture. Some firms look for people who are well versed in Rust, and some firms look for people who are good in C++ instead. So a quantitative dev in prop firm, I want to switch props to HFTs. My personal suggestion will be to apply for a lot of quant hackathons that are actually about HFTs, right? Make a few models, lose a few, winner, and after losing, you will learn a lot of things and try to win them or get a good ranking, at least top 50 added in your resume, and try to apply for internships, right? I mean, you are already a quant dev, so it shouldn't be very difficult because you already have experience in the field. Now, we are pursuing detail and total. Definitely, if you are looking, depends. First of all, if you have a BTech degree, you already are somewhat good in coding. Depends completely upon if you want to work on the quantitative developer side of things. If you want to work on quantitative developers, there is no need to go for basics of finance. But if you want to work as a quantitative researcher eventually in your life, definitely the basics of finance are very important. Now, I think is the most easiest. IITs are easiest in India, yeah. IITs, ISC, IISc, and ISI. These are the most easiest way. These are the lead colleges that will help you get a role easily. Since they are highly volatile and so don't follow. Like your idea, we want to get ML engineer roles after we can go. Talking about quantitative ML, honestly, machine learning in quantitative finance is one of the most difficult things that you could possibly do due to the non-stationarity of the data. Now, what do I mean by non-stationarity of the data is, you remember in the start of the session, I did mention something about your a $10 move in 2026 and a $10 move in, let's say, 2016 is not the same. How will you make the data stationary? There are a lot of ways to do that as well. But still, honestly, if you want to go through the ML approach, definitely read Advances in Financial Machine Learning by Marcos Lopez de Prado. How do you collect data, suppose, for a span of 10 to 15 years, so to implement it, or small time span data? Depends on the time frame, honestly. If you are looking for higher time frames data, it's easily available. Again, if you are let's say, beginner, right? Being a beginner, you can easily get the data from Yahoo Finance for absolutely free, because again, you're trying out things. But if you want to get high quality data, depends on what asset. Wait, can you mention the asset that you are looking to collect data for? Because for US markets, I would definitely suggest Alpha Vintage, or you could go for your Data Bento. If you are trying to go in crypto, you have your Binance, you have Alpaca, right? But again, depends on which asset you're trying to model. Are you planning on sharing free models? Honestly, I will show. I think I did show you all of the concepts that I have discussed about in my cohort, I've attached a free sample model as well. The entire pipeline structure, everything in it, so that you could model working, right? You could see how it makes you money, or how it loses you money, or what are the possible applications are for that specific concept, right? Or if not, yes, absolutely, I am there to help you develop. Honestly, my cohort members, I have talked to them at 3 a.m. in the night. I have sometimes, I know a guy, his name is Luffy. If I'm working with him, if he is facing some sort of issue, again, I do provide code auditing and everything, model auditing. These guys will send me data, and these guys will send me the code notebooks, the codes and everything, and I have to sit through hours understanding the pipeline and where they fucked up. It's a very tedious task, but yes, I absolutely do help you with everything. First, to understand the quantitative finance, then help you develop your own profitable model so that you can deploy it and make money. Because at the end of the day, what are we here for? To make money, right? Now, can we get those roles when we are tier 2 college? UG, if you are from tier 2 college, no. But masters also no. If you have done your undergrad in a bad college, I will definitely ask you to get a good college for masters. You could target Europe, you could target USA, and if you are targeting masters from India, at least go for, again, IITs, IISc, ISI. It's a very well gatekept science. It's a very well gatekept corporate role. So getting in from a tier 2 college is very difficult. But again, if you are winning, there was this Goldman Sachs hackathon, and they had an entry barrier that if you are not from IITs, you can't even register for that. So again, the other way is participate in a lot of competitions, maybe win in a few, or get a rank in a few, and that's how you could get a role. In considering you are from tier 2 college, you're not doomed. Now, I don't think Quant Finance can be it. Cannot be, but it will more or less improve. It will improve quantitative finance. But one thing, I was talking with a quant guy as well. I have talked to people in hedge funds in Portugal, head of department of a university who are offering financial engineering courses as well. So while I was talking with them, we were on a meet, and we discussed about AI as well. The one thing that we found out was that there are opinions were common is that before AI was here, a PhD researcher, quant researcher, used to find, let's say, 3 to 5 alpha signals throughout their whole lifetime, because everything had to be done very tediously, and every code line had to be very perfect, and everything there was no way to do a lot of things before AI. But now, those same PhD researchers are maybe making 1 or 2 alpha generating signals a year, whereas they did 3 to 5 in their lifetime. Now they are doing 1 to 2 each year. Now, what has this done is it has increased the speed of you finding an edge in the market, but at the same time, it has a negative aspect to it as well, that if you can find that signal in the market using AI, maybe somebody else with the right approach can also find I'm sorry, it was muted. So again, if you can find your edge in the market very easily using AI, somebody else as well can, and exploit that same edge. That will lead to alpha decay, and that signal will just stop working and start losing you money. No, like stock side only, I tried for Taiwan market. It was not in Yahoo Finance. If you're a beginner, it's good enough. But other than that, it's not worthy at all. Could you share some more techniques to make data stationary and predictable? I will let you on a secret tip. You know what? I will show you. Just a second. There is an entire video for this in my cohort, but I will present it to you. I will show you. So we commonly trade time bars, that is a 1 day time frame candlestick or something, right? Then we have a tick bars, volume bars, and one of the very easiest ways to actually make your data stationary is your dollar bar, especially when dollar activity is high. This is how your notebook would look like. I will actually now why are dollar bars are usually the best to make your data stationary, and even Dave Praduk recommends dollar bars as default because tick bars are distorted by order splitting algorithms, one large order into small many ticks. Volume bars are distorted by stock splits. Let's say your like Apple announced their stock split or price changes. $100 stock at 1 million shares is not equal to $10 stock at 1 million shares. Dollar bars normalize for price level. $1 million traded is $1 million regardless of price, right? This is the notebook again, part of the code, but still, you ask for how to make it stationary. Now, can you, if we do graduate from tier 2 and we do masters, absolutely. If you complete your undergrad from a shitty college, you can easily, if you manage to get a good college for masters, definitely with the right ability, these elite colleges will provide you the platform. If you have the ability in those elite colleges, universities, you could definitely get a Quant In. Might increase it from where I'm a very secretive guy, honestly. I could share with you, but maybe for another webinar. That's why, because I see a lot of racism, a lot of elitism in quantitative finance. That's why I like to be a bit secretive about me and not go on rambling about things, because I have faced racist DMs, racial comments, right? And honestly, I don't know why this still exists, but still. Thanks, bro, for the time. No worries, my man. No worries. I will try to hold at least one free webinar every single month for you guys, right? And anything else, guys? Is the AI dominating in quant rules? Yes, honestly telling you, I think the quant firms, I have talked to a few people, they are still underestimating the power of AI, especially if you think about models like Fable, Mythos, and now ChatGPT 5.6, Soul coming up. I think they are a game changer. I mean, their critical thinking abilities, their scientific rigor is somewhat similar to a PhD researcher. If you can actually use them properly, you can, with the right knowledge, you could build almost anything. No doubt a lot of quant work will also be replaced by AI in the future. Like people will build proper agents. Even in fact, I'm also working on a platform which I will be releasing soon for quantitative finance. It will be a complete ecosystem where you can easily develop your own quantitative strategies. Do you have any other question, guys, before we end the stream? I think definitely it is harder to get into elite colleges abroad, easier in Indian colleges, but again, if you want the best possible outcome for your career, the best quantitative finance colleges are in USA. Simple. If you have a low budget or not that right marks, maybe you're not the right ability, you could definitely target European colleges. What extra topics we want to learn while pursuing the BTech? Honestly, your BTech might be covering Python, C++, and everything. My personal suggestion will be focus a bit more on maths as well, calculus, advanced calculus, linear algebra, especially probabilities and statistics. Any other question, guys? Any project idea for devs? Me personally, I am more of a quantitative researcher. But talking about devs, you could definitely go for research papers that have innovated a way to achieve those low latencies. You can learn about data structures and algorithms that could help you achieve those low latencies. Because again, if you want to do something about HFT and quant dev, you can also do is you can get a stream of tick data, buy a stream of tick data, or simulate a stream of tick data, or maybe even join a quant hackathon. They will provide you with their own data, and you could apply your developer skills into it to make sure that the stream, maybe you could create an exploit for the spread, right? That's how, honestly, I can't really tell you about devs, but this is what I've seen in devs that I've talked with, right? I'm doing CA, but I have a strong interest in quantitative finance. Absolutely, considering a CA, still you can do quantitative finance and any finance related topics we can cover or we want to master, the maths or coding. Considering a BTech guy, finance related topic, you should know the basics, right? The stop losses, options, futures, how do they work, the Greeks. That is not as a fresher, so you have progress. So you have to progress to yes. Directly quant trader role is not very accessible as a fresher. You have to progress through a quant researcher or a quant developer to a quant trader. Any finance topics, again, the basics of stock markets is absolutely necessary. Options, calls, how does brokers work, how do interfaces work. Again, the rest of the basics like candlesticks, different types of data, alternative sources of data. That's it. With the very basics of finance. You could also learn for option pricing models like Black-Scholes is there, Merton, Young diffusion is there, Aston model is there. I've studied all of them. You also have your binomial model, multinomial model. All right. Mechanical engineer currently working in. Okay. And I've cleared the. Honestly, an ISM research analyst has nothing to do with quantitative finance. But still, it will help you. The RA will help you actually to maybe manage results. Any opportunities to get into quantitative opportunities will not be there, but you can definitely get into basic portfolio management like Nikila Goswal, Muama, and all with your experience definitely. What type of skills most firms see in our resume? Honestly, best the only thing that they will see at the top that will highlight you from the rest is a good rank in a famous hackathon like IMC Prosperity, right? These hackathons, Kaggle competitions, if you could get a rank in them and mention it in your resume, that will easily get you a shortlist. Any other questions, guys? I will be closing the stream in 4 minutes. How to participate in those hackathons? Just keep a live track. There are a lot of, if you need, I will start updating about these hackathons on my stories as well. But you could always Google them as well. Quant hackathons happening right now, right? Join in them. Make a Kaggle. Kaggle ID is the most basic thing that you can do, right? Then we have, so there's some courses or something to get into finance field. If you're looking for something free, you have your Zero the Varsity. If you're looking something that is very technical, or maybe take you to zero approach for in quantitative field, I will definitely honestly suggest my course, quantitative finance courses through Other than my course, if you could, not specific courses, but you could definitely learn from MIT's open source material. You could learn from Harvard's open source material about probabilities and mathematics. Can we join the cohort if it? Absolutely. I mean, I have tried to cover everything. If you have seen the stream, it showed basics of finance, quantitative mistakes to avoid. Absolutely, I've tried to cover all the aspects that you could need. I have uploaded more than 10 hours, 12 hours of content. And with that, honestly, even if you consume that sort of content, it would take you weeks, if not months, to actually apply that knowledge. And when you are applying that knowledge, of course, you will be hitting brick walls and everything. And the best part is you could always DM me and check with me that how to solve this, right? But if you don't have the knowledge how to pref, I don't have the quant knowledge or very rigorous math, start with the basics of Python, start with basic mathematics, and start with the very basics of finance, like stock market, right? How does it work? Don't go to YouTube, please, for finance. Sir, please share the course details. Sure. It's actually my bio as well. But I still put it in, right? It's called the railway.in. It's a monthly subscription, basically. It's some people talk to me about it, and I pitch it as a Netflix, but for smart people. What's in your opinion? We want to build agents for the quant. The old school method will die in a few years. I can promise you that. I have seen a lot of quants building their own platforms. I am building my own platform as well. I'm launching it in July. It's free of cost in the start for the beta testing. It's a new code quantitative developer builder, right? But if you want to future proof yourself, definitely go through the agentic way. But for learning, if you are trying to build agents without the right knowledge, you will be just messing it up. If you are a beginner, go through the brute force old school method, honestly. Right? Thank you so much, guys, for your time. We will be doing another one of these webinars in July, and I will be again asking on my stories what topics do you want me to cover in them, maybe add a few more things. And definitely, you could always DM me with your feedback of the webinar. It's always helpful to know that you guys, I added values in your life. And if you want something else, if you want something more, right, if you want something different, you can definitely ask me. Definitely drop a DM. Thank you so much for your feedback, guys. Thank you so much. Are the quant ML roles? No, quant ML roles. There is no specific quant ML role. Those are quant researcher roles in which machine learning is included. And ML engineering is very easy compared to financial machine learning engineering, because read advances in financial machine learning, you will actually see the difficulty of using machine learning in finance. And again, pro tip, right? Use dollar bars rather than your price bar, tick bar, or volume bar. Thank you so much, guys.